Welcome to another episode of the Wealth Guy podcast, where we're joined today by Nick Chong, founder of Ardent Capital Group and a seasoned expert in mortgage broking. Nick leads a team of dedicated mortgage brokers, shaping the financial futures of their clients through informed educational guidance. Today, Nick will delve into how the mortgage landscape has evolved, particularly since COVID-19 pandemic. He'll unpack the significant changes in lending practices and borrower requirements, offering invaluable strategies for those navigating the complex waters of mortgage procurement in today's fluctuating interest rate marketplace. Whether you're a first-time home buyer eager for foundational advice or a current homeowner contemplating refinancing, Nick's insights aim to equip you with the necessary tools to make informed financial decisions. Join us as we explore these topics and more, including Nick's predictions for the future of the mortgage industry based on current trends and his extensive professional experience. So without any further ado, let's jump into today's episode.
So thanks, Nick, for joining me. Really appreciate it. First question I've got for you, mates, is over the last few years, especially since COVID and that sort of pandemic period, how has the mortgage broking industry sort of changed since then?
Yeah, I mean, there's been a lot of changes, in particular processes with mortgage broking. I mean, as you can appreciate, during the COVID period, brokers aren't allowed to actually go see clients face to face. So one of the silver lining that came out of COVID from a broking perspective is that it forces a lot of lenders to be a little bit more reliant on technology. And I think it's great because it does expedite the application process, the acceptance process, where now we're doing a lot of our interviews online, using via Zoom, Google Meets, Microsoft Teams, etc. In terms of the actual policy, it was a bit of a funny time during COVID, actually. It was naturally it's unprecedented. And what that means is a lot of lenders have to change their policy because nobody knows what the extent of what COVID would actually, how it would impact the economy and everything else. So there was a temporary change around the whole policy piece. But now that we kind of come out on the other side, things are kind of going back to norm. And what we're finding now is that, people are now finding it a bit easier to buy a property. Now, the caveat here is where it was a really funny market with COVID, and we're seeing it again now, is that during COVID, everybody thought that the property market was going to fall off the cliff. I don't know about your experience, but that's the general, feel that we get from people. And lo and behold, it actually worked the opposite way. And this is off the back of rate reductions that we've seen. There was a period of time during COVID, we were seeing rates as low as 1.79% fix. It was a no-brainer, from a financial plan perspective, and to kind of ensure that people can afford to meet those repayments. And we started to kind of see a lot of people wanting to buy properties, despite the fact that majority of the auctions that we've seen is actually online auctions. I don't know if you've done that before. It was quite an experience, actually, comparing to being, going to an auction in person. And then we find out a lot of people starting to kind of buy, and that actually act as a catalyst to start to see the property market increasing. I think I've spoken about this in the past in a different podcast, I think, about FOMO. This phenomenon, it really kicks in, the herd mentality and everything else. And funny enough, we're starting to see, despite the restrictions of being able to visit a property, people were just, having that buying interest, and it actually kind of built that property prices to start to kind of increase and hike, which is a good segue to where the market is now. There's a sudden fundamental shift when, at the heels of rising interest rates, we're starting to see a bit of a correction with property prices. And we know that because, as we assist clients with getting mortgages, we also have to help them with valuation, just to make sure that, everything kind of goes through smoothly. And now, at the height of the interest rates, I wouldn't say peak, but I think we're pretty close to the peak, if you agree with that. We're starting to see the property prices kind of stabilize. Now, that being said, certain pockets are still going to have a little bit more volatility than other areas. But by and large, we're starting to see a lot of buying interest again, despite that the rates have increased, despite that, a lot of lenders have also readjust their policies, in particular living expenses. And this is just to kind of make sure that they capture the inflation that we've experienced in the last 12, 18 months.
And what sort of impact have those changes to policy, particularly around living expenses? Because I feel that at times over the last sort of 2 or 3 years since COVID, the mortgage brokers or maybe lenders rather have implemented these changes that have had more effect on borrowing capacity than just interest rate changes, where policies have changed and they've impacted borrowing capacity, whereas a lot of people will blame interest rates, but it's actually policy changes. Maybe what are those, like you mentioned, living expenses or the HEM, what is one of them? What changes, if any, have been as a result of policy change?
I think I'll probably say the two biggest drivers is the interest rate buffer. So as a standard practice, let me take a step back. In the past, they used to have an assessment rate, which is a fixed assessment rate at 7.25%. That's the way they work out, or the banks work out the affordability for them, whether they're prepared to actually offer you that loan amount that you're requesting. Now, there's been a lot of talks, especially again during COVID, where rates were coming off. Then they're trying to say, well, it's not a true reflection of what the market is. So then the banks decided to go across the board. Let's float the assessment rate by adding a 3% interest rate buffer on the actual standard variable rate. So for those people that don't understand the assessment rate, it's a rate that the banks actually use to work out what your repayments will look like based on the high interest rate, which is whatever your customer rate is plus that 3%.
Yeah, more commonly referred to as the stress test.
The stress test, exactly right. Yeah. Beautiful. So what we've seen now is that one of the key changes we've seen is some lenders have now dialed down, instead of having a 3%, some even use 2%, given that the whole talk about mortgage prison, which is a buzzword at the moment, where people just can't refinance because of those rising interest rates. Some lenders are adopting like a temporary refinance policy change, where they call it streamlined refinance. So instead of using the full 3%, depending on whether you qualify based on their metrics and parameters, they only use a 1% interest rate buffer, right? That would allow you to refinance. But by and large, a lot of people seem to be getting stuck with lending, regardless where you're refinancing or purchasing, is because of the rising interest rates that we see. Couple that with another policy change is that the HEM rates, as you can imagine. In the olden days, and this I'm talking about maybe about 10 years ago, a lot of lenders kind of rely heavily on the ABS, which is just data statistics of what would a typical single person would spend, what would a couple with 2 kids would spend, et cetera, right? They will have that sort of data and would then use that as baseline as part of their due diligence. What we're now seeing as well is that lenders are now incorporating an income-linked living expenses. What that means is, in addition to whatever the data that's actually coming out from ABS, they would also adopt an income-linked expense based on what your taxable income is. So in short, the higher the income that you make, they would just assume the higher your
the more you spend.
The more you spend, exactly right. That is quite an interesting way of looking at it, because naturally, it's not a true reflection on the person's actual living expenses. And we've seen living expenses being adjusted at least 2-3 times, about twice at least in the last 12, 18 months. So it's actually revised upwards.
And I think a lot of people are experiencing that. I've experienced that as well, where I've gone to take out a loan, spoken to a mortgage broker, and they've sort of turned around and said, well, it doesn't matter what you're, like I've told them what my expenses are. And he said, look, that doesn't matter because the HEM or living expense, metric that we have says that I need to assess you at this amount, which is higher because you're a 2 adults, 2 kid household sort of thing. And therefore you're only entitled to a borrowing capacity of X, whatever it is. So I think a lot of people are experiencing that this day and age as a result of those policy changes. And then for a period of time, people were in that mortgage prison until a lot of the lenders sort of turned around and said, well, let's make this policy change that actually enables you to refinance with the same lender and then get you out, give you a little bit of breathing room, get you out of that mortgage prison as well, so that you have that capacity as well. Because one of the biggest things to come out of COVID is it was a fantastic stat around if you've purchased a home in that last 10-year period, you were yet to experience a rate rise, I was dumbfounded when I heard about that. But I'm showing my age. I purchased a home when, interest rates were up and down. And so I've experienced both, rises and reductions, but a lot of people were yet to experience a rate rise. What strategies were you sort of recommending to people in that period where rates were rising and then they were looking to either get some breathing room or make it into the market?
Look, that's a really good question. I think to answer that, it probably would be good to actually start with a scenario, right? I think one of the key things that we see a lot of, or the most common question is that, look, my loan's fixed. I'm about to roll out of the fixed rate period. What do I do? Now, statistically, and this is through our observation, that depending on when you actually roll out of your fixed term, if you roll out as of today, your repayments could effectively be close to double what your initial repayments are. So that could be a rude shock to anybody's household income. It has a direct hit to it. What we usually suggest, and for us, we reach out to our clients because we understand that when they actually come out, they're fixed. So we want to be on the forefront of it as opposed to being reactive. We want to be a little bit more proactive. So when we sit down, we kind of do a quick estimate. We'll call up to them and say, hey, if the client actually rolls out of their fixed term, what would their repayments look like? Then we'll then overlay that with a cash flow analysis to go, okay, well, is this considered to be affordable? Short answer is no. Then there are a couple of things we can do. Firstly, we would always negotiate with the existing lender at all times to see what they're prepared to kind of offer them. Secondly, since there was an introduction of lenders having more like a streamlined refinance, like I said before, a temporary adjustment on the policy to alleviate some of those mortgage prison issues, we'll then provide them with new lending options. The other thing that clients can actually look at from a loan perspective to make it a little bit more affordable for them is to do a couple of things as a short-term measure. Is potentially, if you can refinance, reset the term loan, right? That would ultimately reduce your monthly repayments. 2, there's certain lenders that will allow you to have a hybrid option where you can have a mix of principal and interest-only loans. Again, this is under proviso that you're able to kind of service and satisfy all their lending policy. But structurally speaking, from a cash flow standpoint, if we can incorporate, for example, for us, we help a client by switching about 50% of their facility to interest only and have the other 50% of principal and interest, it reduces their repayments significantly enough for them to go, yep, this is a little bit more affordable for us. So not the most ideal if it's an owner-occupied property, but it is always going to be a short-term solution until the market changes. Like anything else, right? Everything goes in peaks and troughs. So once we start to see a reduction, we can then revisit the strategy. I guess the take-home point is very simple. You need to actually find a broker or an advisor that would be able to kind of keep a finger on the pulse with what's happening with your financial situation and what's actually happening in the marketplace, because things can actually change quite quickly. Quite dramatically. Sorry, didn't mean to click.
So look, I find a lot of people are in that position or even more recently they have been in that position, because particularly if we wind back the clock to sort of 2021, we saw interest rates of around about that 2% mark, give or take, 0.1, 0.2, whatever it is. So a lot of people have either recently or will be in the near future coming off those ultra low fixed rates. And if anything, their interest rate is going to triple and they may find themselves in that position. What advice do you have to those people who are in the coming months coming off those ultra low fixed rates and into a higher interest rate environment?
This is exactly what I've discussed before, which is, I think, firstly, go speak to your broker, go speak to your bank and explain to them that, okay, well, what would the repayments look like? The last thing you want to do is to be reactive, because by the time you try to be reactive, and your circumstances doesn't allow you to be reactive, then you can go into a financial stress quite quickly. So once you kind of actually get an understanding, you speak to your broker, speak to your advisor, review your budget. At the end of the day, the fundamental thing with affordability is budget. Can you afford this? Now, then you have, if you've got a broker on site, or you have a financial planner, that's another good way to have that open discussion, because the reality is that it's a moving freight train. It's not like you can jump up and down, cry about it, that it's just going to stop there. It's going to happen. So you'd rather be mentally and financially be prepared for it, so that when the time comes, we'll know how to start executing your strategy. So the number one thing is always understand where your financial position is post fixed rate, then work out, okay, is there going to be an affordability issue? Are we able to kind of restructure your debt? Like I said, have a bit of a hybrid, a bit of a mix between principal and interest, or interest only, or completely interest only. Worst case scenario, if it's absolutely dire straight, you can actually go back to the bank and ask for a repayment pause. We would almost never want to recommend a repayment pause because it's a very short-term thing and it doesn't actually address the issue. It does give you some breathing space, but that should only be considered if you're thinking about, for example, after reviewing your overall financial circumstances, that we need to kind of reshuffle my property portfolio. So in other words, we're looking at downsizing it, make sure that we offload some of the debts, take the proceeds, then we can use that to invest into another investment that can give you a better outcome or put into your offset account, as an example. Then under that sort of circumstances, you can probably ask for a repayment pause while you're preparing to sell the property. But we almost never want to kind of recommend that if you want to hold it for the long term, unless it's absolutely necessary.
There were a few good and important strategies that you mentioned there for existing home loan owners or mortgage owners. But what about if I'm a first home buyer and I'm looking at getting into the market? How can I best prepare myself?
I think there are a couple of things if you're a first home buyer that you need to start doing. Is firstly to understand the actual process itself, right? So when you put in an application in, the lender would generally look at your income, assets, liabilities, and expenses. One of the key things that we've seen a lot lately anyway is that people are constantly chasing after those reward points, Qantas frequent flyers, etc., which is not a bad thing because it does make financial sense if Amex is giving you $250,000 points, which you can then convert and monetize that into a travel, well, whatever it is, ticket, whatever that you want to do. But the unintended consequences of actually doing that is if you have too many inquiries, it does actually reduce your credit score. Now, we have lenders that don't actually look at the credit score in isolation, but we do have lenders that rely heavily on the credit score. So if you aren't aware of this and you keep going from one credit provider to the next, to the next, to the next, leading up to your application, it may actually reduce the credit score low enough to where it goes, hey, look, certain lenders doesn't fit the bill because of that fact. Secondly, it's always good to prepare, always good to understand what is it that, what is it that you're actually eligible for. Things can be very time sensitive. One in particular that comes to mind is the first home guarantee scheme, because the first home guarantee scheme is based on your notice of assessment. We had a client that knowing that, in the following financial year, he's going to breach the threshold. So knowing that upfront earlier on, we decided to go, hey, look, if this is what it's going to happen on balance of probability, we should start your buying process now while you still considered to be eligible for the first home guarantee. An example would be if you're single and it's income tested for first home guarantee, if you earn more than $125,000, which is noted on your notice of assessment, you automatically aren't eligible for it anymore. So which is why timing sometimes is also important with self-employed in particular. We always try to kind of plan ahead because unlike your standard PAYG, your employees, your income is actually quite static. It's quite consistent. Self-employed, not so much. Which is why, when it comes to the self-employed clients, we generally want to make sure that because, all right, let's prepare. It could be this financial year or we have to roll it to the next financial year. That's why we work closely in with accountants. For the clients that have a bigger portfolio, we're working with financial planners just to make sure we're able to kind of optimize their borrowing capacity, interest savings, and tax at the same time. So roundabout way of saying that first home buyers, be cautious about not making too many credit inquiries. Understand what sort of government incentives that's available to you because sometimes it requires planning. And thirdly, don't just talk about borrowing capacity. We get that quite the most frequent question, what is my borrowing capacity? So we always talk about, look, borrowing capacity is one part of the puzzle, right? What we need to kind of understand is what is your affordability? Which is probably more important, especially given that, what we've seen in the last 18 months with the rising interest rates. So part of the thing that, we suggest first home buyers to actually engage with whoever broker you go to or lender is to work out what would the repayments look like? And is that actually going to eat away into my lifestyle? There are times where we are able to kind of achieve, for argument's sake, $1 million into the loan size. But by the time we crunch the numbers, we worked out that, look, if you want to kind of be able to maintain this, in addition to us, we actually do a sensitivity analysis by adding another 1% interest rate on top to see what that looks like, to factor in potential rate rises. How does that actually impact you? How does that impact your back pocket? In that particular example, we worked out that the client's not prepared. Even though she has the capability to borrow up to $1 million, we decided $800,000 is the sweet spot because it doesn't push her into that financial stress. When it comes down to recommendations, it actually forms a very big part.
The person's actual tolerance sort of thing. Yeah,
absolutely. The risk tolerance, if not, you want to be in a position where it becomes, look, it's too heavy for me, too much financial stress, then you start to make, silly financial decisions. I always like to tell clients that there are different horses with different courses, right? So if you have a high risk tolerance, that's fine. We can kind of push the envelope with that. But the most important part, as you well know, in the advice space, it's all about making the right and informed financial decision. Just because a strategy for me works for me doesn't mean it works for the next person, because I may have a higher risk tolerance, or I could be a little bit more on the conservative side. That's why it's important, especially if you're first time buyer, is to really appreciate and understand where your financial position is and what your tolerance are.
And I think that's probably one of the biggest benefits of going to a mortgage broker like yourself versus a traditional bank lender as well, because your bank home loan lender, they'll just have, we got 2-3 home loan products. This is what you're eligible for under those 2 or 3. But a bank lender will go, as a mortgage broker will go and assess your financial position, understand your current state, and then find the product that's right for you based on your tolerance, financial position, needs and wants sort of thing. So if anything, that's probably one of the benefits of going to a mortgage broker as well. Today's episode of the Wealth Guide podcast is proudly sponsored by Ryker Capital. In a world full of financial uncertainties, Ryker Capital understand the importance of safeguarding your lifestyle and the well-being of your loved ones. That's why we're committed to providing you with personally tailored insurance plans and financial advice that aligns with your unique needs and goals. Ryker Capital is your guide in the complex world of superannuation and retirement planning. Our team of experts are dedicated to helping you navigate these complexities with ease and confidence. We're here to empower you with the knowledge and strategies you need to build wealth and secure your future. At Ryker Capital, we offer a comprehensive range of services designed to optimize your superannuation. We work closely with you to determine the best contribution strategy, regularly review your superannuation fund, set achievable financial goals. Our coaching and consulting services ensure your financial plan stays on track with regular reviews to adjust to your changing circumstances and aspirations. Don't leave your financial future to chance. Take control today with Ryker Capital. Contact us for an obligation-free discussion about your financial plan by calling us on 1300 179 537. Let us help you secure your finances because you deserve it. Ryker Capital, your trusted partner in financial success. One thing I wanted to ask is, how can first-time buyers best prepare themselves ahead of going through that home loan application process? How do they clean up their finances, if anything?
Well, again, the first step is actually to speak to a broker or a lender, because we need to kind of really understand, firstly, what is it you're looking at achieving? It kind of goes back to that old adage of really understand the client's needs, right? Because once you kind of understand exactly what they're looking at purchasing, then we can then reverse engineer the entire strategy to go, well, if you're looking at $700,000 on property, depending on what sort of government benefits that you may be eligible for, you need to come up with an X amount of deposit. At that stage, we'll then have a look at that and say, okay, well, based on the way your savings, do we have any sort of flex around paying off your HECS? Do we need to kind of clear out your personal loans? As you can imagine, things like personal loans, in particular, or car loans, because they have a very short finite of term loan, typically 5 to 7 years, the repayments are significantly higher. Would it be better off for you to kind of then pay that down, depending on how much you owe, of course, right? Pay that down and then ramp up your savings to then give you not only more deposits in a very short space of time, but also it improves your borrowing capacity.
Because I'd imagine that sort of debt will have exponential benefit on your eligibility for home, like credit card debt, personal loan, car finance, even like things like Afterpay as well. Do they have any impact?
Oh, of course. Yeah. Afterpay just came on the scene probably about 5-6 years ago now, maybe a little bit more. But back then, Afterpay was not incorporated into the assessment. Now it is.
Yeah. Okay.
And the thing, what they generally do is, by the time you put an application in, all lenders would actually request or do a quick credit check on you. What we've seen is that in the past, buy now, pay later sort of facilities almost never appears on the credit report. Now it does. So when the lenders actually look at that, they'll actually factor everything in.
Because it is a form of credit.
Correct.
Like realistically, yeah. And then nowadays, everybody has about 5 or 6 online subscriptions to something as well. Does that have any effect on their expenses or credit rating or anything like that?
When it comes to subscriptions, yes, it may have an impact, but again, depending on what type of subscription it is. So, for example, things like Netflix or Amazon and whatnot, some of them, and most lenders will actually consider that as part of your basic living expenses. So we got to be very mindful, what actually impacts the borrowing capacity when it comes down to living expenses. And it's a good point that you make, by the way, is that living expenses is actually split into two. There's a basic and then there's a discretionary. So basic, like we discussed, it's based on stats that's released by ABS, as well as whatever that income link formula that they use to work out what they think you should spend at a minimum. That forms part of your basic living expenses. And then there's the discretionary living expenses. So discretionary living expenses would be your private health. Discretionary living expenses would be, strata fees that you may potentially have to pay if you're buying an owner-occupied property, life insurance, and like I said, health insurance. If you have, a secondary residence, so they have different lenders will obviously have different definition, right, or what they include as a discretionary. But it's discretionary that's actually added on top of your basic living expenses, which then reduces your borrowing capacity. So a couple of things to kind of bear in mind when you're leading up to buying property: speak to a broker, review your living expenses, review your discretionary living expenses. In terms of life insurance, can we place it inside super? Do we have it outside of super? That's probably a discussion with your financial planner, because it's very important to kind of understand what works for you. But from a borrowing capacity or from a borrowing perspective, these are the sort of expenses that will be taken into consideration. So if we can kind of make sure we dial that down as low as we possibly can, that would actually help you out. And drawing back to what we were saying before, just make sure you don't do a whole lot of credit inquiries unnecessarily leading up to it. And most important part is to speak to a broker to have a broader understanding of what you're looking at achieving, because the entire strategy actually comes down to what is it that you want. Then from that point, we can then look at, okay, well, if this is what you want, this is what we need to borrow, what are the factors in your current circumstances that's impacting it? That's when we understand what sort of levers we can pull and push. I know it's not a very definitive answer, but because everybody's scenario is so different, the number one thing I always tell clients is speak to an advisor, speak to a broker, get them to fully appreciate what is it that you're trying to achieve. And you'll start to see that they'll be able to build out a strategy or a blueprint on how do we get there.
Yeah, and look, I think a lot of people need to have that, understanding of the overall process and how it impacts their finances as well, or how their current budget impacts their finances, because there are a lot of little things that people can do to have a positive effect on their mortgage as well. We talked a little bit before about refinancing, and especially as we come to the end of a fixed rate period, that might be a bit of a trigger point to say, oh, hey, I should think about refinancing or seeing if I can get ahead of mortgage prison. Are there any other trigger points that people have around, okay, now is a good time to refinance? When are those trigger points, if any, around refinancing?
There's a rule of thumb for us, in terms of how we actually look after our clients, is that we try to be, like I said, be a little bit more proactive than reactive. So what I mean by that is, with clients that we onboarded, the first 12 months or at the anniversary of your settlement, our team would actually reach out to the existing clients on their behalf to kind of squeeze them on the rates. It's just an additional service that we provide. Then the following 12 months, we conduct what's called a full home loan health check. So in short, you should never actually wait for any sort of real trigger points or any sort of economic changes that really hits you in the pocket before you go, hey, you know what, I think I need to kind of review my finances. You should actually be reviewing your finances every 12 months to 2 years, or 1 to 2 years, basically.
No, I think that's important because it's almost like a doctor. Like, you need to have regular checkups to know if something's wrong.
Absolutely.
You don't wait for something to go wrong. So I think that's important. And that's great that you provide that service as well to ensure that, yes, everything is on track, and also to double check, have your goals changed as well, or even policy changes. Hey, do you know that we can get you a little bit extra, or we can, now that you've been with us for however long, we might be able to look at reducing your rate. So I think it's very important to have those conversations, if any. Looking to the future, what do you feel is going to happen in the next sort of short term, that 2 to 3 year period? Because I feel like we've come to a point now where house prices, especially in Sydney, they've sort of hit like an affordability ceiling almost. And I'm seeing performance in terms of growth taper off. And even I've seen some of the banks reduce their 3, 4, 5 fixed year interest rates as well. What are you sort of predicting for the next short-term future?
Within 2 to 3 years, if I were to, general advice, by the way, just a bit of a disclaimer, if I were to kind of give my input on this, firstly, in terms of where the rates are, on a balance of probability, I feel like it's rounding the corner. I think it's actually definitely at a peak. And a good soft indicator is, the major banks in particular announcing rate cuts on their fixed rate product. We've always kind of relied on them to go, well, if these guys are reducing their fixed rate product, generally speaking, they would have crunched the numbers and go, like, more than likely, we will start to see a decrease in the interest rate. So I'm in line. In terms of where I think it's going to head from a rates perspective, we definitely would see a rate reduction. We just don't know when. Not too long ago, people were saying that this is the year that we're going to get a rate reduction. It started off with June, July period. Then it was August. Now it's like, let's go 2025. Now it's pushing it to mid-2025. It's almost asking like how long is a piece of string, in terms of when it's going to happen. So for me, we know it's going to happen. We just don't know when actually it's going to happen and how aggressive the rate reductions will look like. Because ultimately it depends on the economic metrics that they use, right? Mainly the underlying inflation rate. I think if they were to start to see a rate reduction, that could potentially serve as a catalyst for another property run. Because what happens is, like we said, the interest rates or the borrowing capacity is a function of the interest rate. If the interest rate starts to reduce, we're going to see people have more borrowing capacity, more money to spend, which means that they're prepared to make a higher offer. You can start to kind of see that circular relationship, that compounding relationship upwards. So it could potentially be one of those things where, hey, rates are coming off. People had enough of rental increasing. You may even attract new buyers in, and that they could spur and become the next property run. So I think it's a good thing, but at the same time, it's rate reduction is definitely welcome, especially from people that currently have mortgages, trying to kind of tackle the inflation rate, cost of living. And not too long ago, there was a data that came out stating that all those COVID savings that we had in the past, it's pretty much depleted.
Yeah, I saw that stat as well. Like the average person had, I think it was 20 months worth of savings during that period. And now they're down to sort of a month or so.
That's right.
Yeah. And I think a rate reduction would be welcome, because I feel like a lot of people are almost figuratively holding their breath. They're doing day by day, cost of living crisis, high inflation, interest rates, they all make up the affordability metric, if anything. And I saw a stat out the other day that the average Sydney house price is roughly, the mortgage repayments are roughly 2/3 of a person's or the household's income. That being said, typically in property investment circles, we typically look at like a 30% benchmark in terms of affordability. Yeah.
Correct. Yeah.
And so we've blitzed that affordability benchmark, if anything. So I think a rate reduction would be welcome. I feel like the economy is feeling it, because I see businesses out there, then they're just like, people aren't spending money anymore. So if anything, I think that would be welcome. Yeah.
Yeah. I mean, we're also seeing unemployment rates kind of creeping up too, right?
Yep.
So they kind of give more support that there should be a rate cut around the corner. Again, we just don't know when. That's pretty much it. Yeah.
Awesome. Well, look, Nick, I really appreciate your time and your insights. Last question for you. If anybody has any other questions, how is the best way to get in touch?
Well, you can definitely go to our website, rateseeker.com.au. Sorry, let me start again. It's www.rateseeker.com.au. We have a contact page where you can just put your details in there, and then one of our team members actually reach out to book a time with you.
Yeah, awesome. Thanks very much, Nick. Really appreciate your time.
Beautiful. Thanks, Jeremy.
Thank you, mate.
The information provided in this podcast is for general information purposes only and should not be considered as personal advice. Always consult with a qualified professional or expert in the relevant field for personalised advice tailored to your specific situation.
If you enjoy the content we bring you on the Wealth Guide podcast, we'd love for you to subscribe and share with your community. Let's grow this community together and make financial literacy accessible to all.